Hi traders, good evening. Welcome to this live webinar with FXDD. My name is Chris from Elite Currency, and today's focus is Fibonacci in the financial markets. Part one, it is a beginner's part. All right, we're going to look at the basics today, and then we're going to have a part two and a part three, all different levels within the Fibonacci group, maybe even add a fourth. Let's see if that's needed or not, depending on your feedback and how it goes. All right, but definitely part one, two, and three, so that everyone can understand the very beginnings and move up gradually to the more complicated and advanced concepts. So happy to be here with you. I'm looking forward to having these webinars with you because Fibonacci, in my eyes, is one of the best tools there. I think it's very useful. It's a relatively, it's easy and more difficult at the same time, depending on how you use it. But it's just a very useful tool in many levels, from targeting to support and resistance levels, and also for even entries and bouncing spots for entries. So a lot of good uses. But before we dive into today's topic, though, a little bit of a homework for all of us. Risk disclaimer. Just explaining the fact of the high risk involved in the financial markets and Forex in specific. Please be aware of all the risks involved by speaking to an independent financial advisor. This, of course, is just for educational purposes only. All right. So with that said, I'm going to show you some live charts now. Hang on. There we go. Let me just make that the focus. That's it. All right. So I wanted to make it as practical as possible. So what I want to do is really look at the charts with you and focus on what is useful for you as a trader. The theoretical parts, I think we'll try to minimize as much as we can. So Fibonacci basically is a tool on your MT4 or MT5, and here you can see the FXD MT4 that you can find by clicking on the F here, all right, right in the top corner, or you can go to Insert Fibonacci, and then you have different Fibonacci tools. Retracement is the one you're seeing right now on the chart. That's the most commonly used one. So what does the Fibonacci basically do? Well, it basically says find a swing, which is one price point to another. So let's identify one price point. And let's do that with a rectangle like this. That's one price point, and this is a price point. And let's do that again. All right. So these are two price points. And the Fibonacci tool is placed between two price points, a starting point and an end point. And what it does is give you levels in between the starting and the end point. And those levels are based on ratios, all right? Fibonacci ratios are based on the Fibonacci sequence levels. And as you might know, sequence levels are a mathematical calculation, all right? And they are based on a very simple sequence. In fact, 1 + 1 is 2. And then you drop the first number and you do 1 + 2 is 3. You drop the first one again, 2 + 3 is 5. And you drop the 2, and then you have 3 + 5 is 8. So this is the sequence of Fibonacci. That's not really that important, but it's just good to have an idea where that comes from. And these Fibonacci ratios are basically the numbers that you have in this sequence. You divide them. So 5 divided by 8 is actually 61.8. That's how actually the Fibonacci levels are calculated. And all of these levels are actually calculated based on that, except the 50 fib. We add the 50 fib generally because it's a 50% kind of mark, halfway mark, which is useful. But technically, it's actually not a fib level. But it's just useful to have on the tool when you're already looking at these levels. Might as well add this one. But it's not technically a Fibonacci level. So, for some of you, this might be very, basic and introductionary, but that's because this is part one. We're doing this on purpose for everyone who is just starting out. All right. If you're looking for more advanced stuff, we're going to have that in part 2 and part 3. So the tool itself, let's dive into the levels first. So I just gave you a rough an idea about how these levels are calculated, but it really is not that important in the sense that it's more about what you can do with these levels and what these levels represent. All right. Now, these levels here that you see are the levels I use. If you add the Fibonacci tool yourself in MT4, you will have different levels. You will not have all of these levels. I think you will have 38, the 50, and the 61.8 fib, perhaps. I'm not sure. But these are the ones I have, and I recommend them to everyone. And they are, let's see, 8 in total. And Ali just checked for us nicely, and there are indeed the ones I mentioned are the basic ones. So the ones I add are the 23.6, the 78.6, and the 88.6 fib. And all of these fibs basically are important in my view, and they represent different meanings. All right, so the 23.6 fib is relatively shallow. 38.2 fib is actually 23.6, I should say, is very shallow. Sorry, 38.2 is shallow. 50 and 61.8 fibs are medium supportive resistance levels. 78 and 88.6 fibs are very deep retracement levels. The 100 is the top, and the 0 top or bottom, and 0 is top or bottom. So these are what we call Fibonacci retracement levels. So what that means is that if you have a swing, as we already indicated at the very beginning, from bottom to top, for instance, let's take a look at that. Why from bottom to top? Because the bottom was more in the past than the top. So that's how you decide the sequence. So this was an upswing. So we can move it from bottom to top. Now, I should say that there are also traders who do it the opposite, actually. All right, this is my method of doing it, but actually there are also traders who switch that, and I don't think there's any right or wrong here. Both have their own advantages and disadvantages. So that's really up to you as a trader what you prefer, and they do it this way. All right, so there's really no right or wrong, but I will use my way in the rest of the examples. And what you can see, what I consider shallow is the 23.6. So what happens is you have a push up. Let's make this a little bit bigger. You have a push up. So this is a bullish swing. It's a push up. And then price moves down against that particular upside direction, right? It retraces lower. So the first potential stalling or stop spot, basically, right? The potential bounce spot, a place where price could halt and not continue lower, not retrace deeper, all right? Hope it's clear. Then that is 23.6 fib. And it doesn't have to stop there necessarily. So let's put a shape there. There we go, like this. So that's 23.6 fib. That is, so if price is falling, right? Let's put some arrows so it's very clear. Let's do that with arrow up. So it's moving up right here. And then it starts to decline and make a retracement. All right. So it's moving into the 23.6 fib. That fib could be a potential bouncing spot. In this case, it wasn't, as you can see, not on this time frame, not on this monthly chart. But if we zoom in to this area on a lower time frame, we might actually see a reaction. Maybe on a 1 hour chart or a 4 hour chart or a daily or even a weekly chart, there could be a reaction. So whether price responds to a fib or not, sometimes depends on the time frame. Sometimes we don't see it on a certain time frame. Sometimes we do it on a different time frame. That depends. But in this case, on this time frame, we didn't see any reaction, and we saw a continuation lower. This is quite a high time frame, so it's maybe not the best example. But price went through in a way to the 38, kind of went through it, but it bounced at the 50 and halfway to 61. This is not the best respected fib I've ever seen, to be honest. All right, but that's okay. Those things happen. That's part of the market, and that's also sometimes the more difficult aspect of using fibs is because you have to decide where to put the fib on the chart. It is a manual tool. It is not an automated tool, and something, therefore, you have to really closely look at what swing you choose. Where do you put that fib on? And that is something of a, that makes it a little bit more difficult, a little bit more tricky. But there are some rules we'll share throughout these 3 webinars that make that more, that make it easier. All right, so the 23.6 fib is the first potential bounce spot. It didn't, but if it does, then it reacted to that level. The second with the 38, etc., and then it tries to go deeper and deeper. Now, it could bounce at the 23.6 fib, but still retrace deeper. Just because it bounces at the 23.6 doesn't mean that the price will continue with the upside, in this case, the bullish movement, for sure. There could be a reaction to the 23.6 fib, but price still retraces deeper to the 38, 50, or even further. Basically same principles are valid for all of these fibs. There could be a reaction to the 78, but then still one more push lower to the 88.6 fib. So all of these fibs could be what I call respected, which means that price bounces at these fibs. That's what respect means. Or price could just go through them and break the 23 and go to the 38 and maybe even fall to the 50, right? If that could happen as well. So I would say roughly, as a rule of thumb, 2 out of 3 times the fib levels get respected. Price stops at those levels and bounces for some movement. And 1 out of 3 times, price actually breaks through them. This is a rule of thumb. It is not something I have statistics of. This is just based on my experience. 2 out of 3 times. So that's 67%. Which of these fibs is used is anyone's guess. What does help is the Elliott wave theory and the wave principles. And Ali was asking if we're going to have some webinars on that. And we don't have it planned as yet, but it is something we can think about, indeed. So it's good you mention it. So that helps. And, we're not going to dive into Elliott wave theory here, but just for practical purposes, that's something we'll probably explain later because it's a little bit more complex. But based on the theory, you will be able to understand which fib is more likely in which scenario to be used. But that's something we'll dive into later. It's a little bit too much now. So just for the moment, it is important to know that all of these levels are either support or resistance. In this case, there's support because we're expecting price to bounce off these levels to the upside. Well, in this case, maybe we should use a more practical time frame than a monthly chart. Let's go to the 4-hour chart. And let's put a fib from here to here. And this is the low and the high. And we expect a bullish continuation. And we had a bounce off the 78.6 fib. So we see that price in this case respected 23.6 fib, 50 fib, and also the 61.8 fib. And you can see a little bit of reaction at the 50 fib, but not much, right? So let's look at these reactions. 23.6 fib was a very neat bounce and a quick reversal, but ultimately it didn't break the high and it kept retracing lower. So then it hit the 38. There was some pause, there was some candle there, some volatility around the 38, but that was actually quickly broken down to the 50. The 50, you can see there was respect for the 50 initially, also a bounce up, but then there was quite some volatility around it, then dashed down to the 61.8 pretty quickly. There was a bounce off that, hit the 50, went down to the 78, and the 78 was a very clean bounce, quick reversal back to the upside. Which fib ultimately will be the place where price really reverses for a larger move up? Let's say price moves up like this, goes for a higher high and just skyrockets up, all right? Then in retrospect, we can say, okay, the 78.6 fib was the turning spot. Price respected the other fibs, but it's really the 78.6 fib that was the bouncing spot, right? That's something we really don't know beforehand. As I said, the LA wave can help a little bit. Otherwise, it is a little bit of you try and hope for the best, and try to maybe trade some of these fibs and use good trade management by moving to break even if price does bounce your way, so that you don't get caught in a deeper retracement. All right, so that's one ways of some tactics you can apply. You can also wait for breakouts before trading it, for instance, either here or here, to avoid some of the maybe unsuccessful bounces. Anyhow, more importantly is to know for the moment that all of these Fibonacci retracement levels are potential bounces. Some of them are going to be the major reversal spots, and some of them might actually fail. And so when does a fib fail? Basically, if you have identified a swing, then if price goes through the bottom or top, in this case the bottom, how I draw the fib at least, I'm bullish on this chart, I'm bullish on the swing. So we have a major swing from bottom to top. So if price were to go through this bottom here, then this fib is, the bullish expectation I have is invalidated as price breaks to the bottom, basically. So unfortunately, in that case, the retracement and bounce levels, I expect that these fibs did not fully materialize, at least, right? We didn't get a full-fledged bounce and continuation of the uptrend, and price invalidated and broke the bottom instead. So that would be invalidation. So let's take a look at a different example. Let's use bearishness maybe for now. 1 second. Let's scroll a little bit back, and let's put a fib from this swing to this swing. So what we see is basically price making a very good bear swing, and you can see that it's breaking key bottoms here, key trend line. There are many reasons to consider this a very strong impulse, and also therefore a very good swing for placing a fib. For the moment, let's just use the swing, and how to identify swings is a little bit more advanced. Let's just put the fib on from top to bottom here, because we're looking for a continuation of that bearish swing. And you can see that the top in this case was prior to the bottom. So we will put it from top to bottom. Once again, other fib traders might do the exact opposite sequence. They might go from bottom to top, but this is how I do it. So price falls, and as it moves up, it's retracing. As it hits these Fibonacci retracement levels, all of these levels could be potential bouncing spots / reversal spots. In this particular case, price hit the 50 fib, but did not go any deeper. It didn't hit the 61, it didn't hit the 78 or 88.6 fib. Those were, in retrospect, not used, right? The 50 turned out to be the major turning spot, and that's where price started to move lower, hit the -2.7, and these are targets already. We'll talk about that a little later. But so the 50 fib was the major turning spot here with that particular swing. All right, so let me dive a little bit into this tool itself. All right, before we continue with too many advanced concepts. Now, let me see if I can share this with you. 1 second. Yeah, good. Now I can somehow. Good. So what you want to do, first of all, is when you place the tool on the chart, you want to know how to edit it. So you place it. Let's do that together. You click on the F with the left mouse button. And for the moment, what you want to do is, if you really want to find the correct swing, you click on the beginning, drag with your left mouse button, and let go when you found the end. All right, so once again, click with your left mouse button, to activate the Fibonacci retracement tool, click, drag, let go. So that's how you add the Fibonacci retracement tool. If you want to edit the properties, double click on any of the starting or the end spot, all right? Then click on the right mouse button, left click on Fibonacci properties, and you get this window. You have levels on the left, description on the right, and all the levels like that. You can add. You can add by clicking on add. You can delete. You can change the color, the thickness, and you can decide which time frame they are valid on. And you can also indicate maybe the color for the line that gives the starting and end spot. You see this is a dotted red line. You can make that different. Let's focus on the Fibonacci levels. What we want to do is basically, if you like the levels I use at least, you can do that by adding it by here, like 0.236 in the level. In the description box, you then add 23.6. And what is, I think, very useful is then add a space and a percentage dollar sign. And then you get the actual price level after each fib. So I think that's particularly useful because you just instantly see what the price level is as well for all of the fibs. So I add 0.23.6. The level is the actual level. The description is what you see on the chart. So I add 23.6 and I add 78.6, 0.786, 0.886. And those are the Fibonacci retracement levels. Now, as you can see, I also have more levels on this chart. So let's talk a little bit about that. You can add basically all of these levels if you like, the ones I do. So let me show you all of those levels so that you have an overview. So besides the this is a bit small. Let's do it like this. All right, there we go. Yes, now they're all on the chart. All right. As you see, I have many. I have, besides the Fibonacci retracement levels, which is the levels between the swing. So when you have a swing from here to here, these retracement levels are in between the swing. But I also have levels that are above and below the swing. So let's put the fib from here to here now, just for the fun. And you can see that, or let's do it a little bit smaller so you can see a little bit more. Like this for the moment. So you can see that there are levels above it and levels below it. So these are targets, and depending on how you use the fib, it is for targets for up or downside. How I use the fib, I have minus levels that I use for targets to the downside. So because I swing from, in this case, for a bearish swing to the downside here, and a retracement to the upside and continuation to the downside, these minus levels are acting as targets. If you use the fib in the opposite direction, some traders do, like this, then the positive levels are actually targets. So it depends on how you fib, but I'm going to continue with my style, which is from past to present, right? This swing is past. This is more closer to present. So the retracement hit the 61, and if it hits 61.8 fib, and if it breaks this bottom, then it will aim for these minus targets. So as you can see, the Fibonacci retracement tool itself can be expanded for your use. You can use it for understanding the retracement levels. You understand, because you use the fib, you understand swings better. You understand where to put the fib on the swing eventually. You understand, you should have a better, you should know, eventually the trend, of course, is very useful for fib placement, because if the market is ranging, like in this area here, for instance, and you use fibs in that, well, then the fib might get invalidated quite often. So it is best used when the market is trending and you're looking for a retracement within the trend. So you'll get better at that. I think you'll practice to understand that better because you want to use the fib. So you understand swings better, where to place the fib on the swing, trends, when to use the fib and when not to use the fib. Specifically, once again, when the market is ranging, you don't want to use that fib. It could be a little bit dangerous. Or you can zoom out to a higher time frame or a lower time frame to understand the market a little bit better. And for instance, if you zoom out, you see that this is a range. So you wouldn't put a fib in this area, but you would then zoom out and say, oh, I have to use this fib or I have to use this fib. So you can see the bigger picture and you can find the correct swing on that higher time frame. So by zooming out, you get more clarity on the trend and what's going on, and you can find the better swing to place the fib. Besides Fibonacci retracements and potential bouncing spots and potential entries that are connected to these retracements, because based on these Fibonacci retracement levels, you can think about entries either directly at the level, at the fib level, or after a reaction at that level. It is also useful for targets. Here, the -272 targets like this and the -61. Now, as you can see, I also have positive levels above. And in that case, that would be when price actually invalidates my fib, for instance, or it doesn't have to invalidate it necessarily, but if price breaks above the origin spot here, in some cases, you can have a big range. You can have a big consolidation like this. You have a move down, you have a move up, and you have a move down. And what I use the 138.2 fib for, once again, it's above the top, is it's the final correction level that a consolidation zone could reach. If it goes above that, right, in this case above that, then it is not a correction anymore, but a trend that is in this case an uptrend. So up to 138.2 fib, it is basically still could technically be a corrective zone. So just because it breaks the top, it could mean a consolidation. It doesn't have to mean necessarily a trend, although there is a decent chance of a trend as well. It depends on a little bit on circumstances. We'll dive into that later on. But you just, for the moment, you need to know why I have the 138.2 there. And I also have 161.8 and 261.8, but I don't really use those too often. So that's really up to you if you use it. But that's the reason for me adding 138.2, so that you have an idea. And we'll dive into specifics later. So these are all the levels. Let's go back to the properties here. Once again, right click, left click, and then you can add them. So you can see level 1, 138.2, and then I have -2. So what I do is, and this is something that I think you don't see that often, at least not in the past, maybe more nowadays more, but -0.272, -27.2. This is, between you and me, is a very valuable information, because as I said, a lot of traders don't look at minus targets for targets, and it is a very beneficial way of looking for targeting. It is very accurate, and I think that you will really gain a lot from using those levels. So definitely recommend that you use them. -61.8 target is the major target. In most cases, -272 target is the first one, but in many cases, the -61.8 target is kind of the golden target to look for. Now, it could extend further than that. Which target is used in which cases depends also often on the yellow wave, and that is why often waves and fibs are such a good match. This is the second time already that deciding which fib target to use is supported by wave theory. That's way too complicated for the moment. At this point, if you're doubting which target to use, you could use the first target just to be on the safe side, or you can try to find confluence with other support and resistance levels to find a fib target that might work out the best, right? So if you see pivot point at the minus 61.8, that might be a bit better. There are a lot more minus targets, actually. Let's put this a little bit closer. As you can see, all the way down to minus 423.6. So we have minus 272, minus 61.8, minus 100, minus 161.8, minus 200, minus 261.8, and minus 423.6. So it goes very far. These are the two key targets, but sometimes on lower time frames, let's dive into that. You can see a very big push. So if we put a fib on this very first swing on a 50-minute chart, you see a 50 fib bounce, you see a swing up, right? So from left to right, from past to more present. So we put it from down, bottom, higher to the top. You see prices retracing, hits the 50, bounces at the 50 without breaking below the bottom. And yeah, it does reach all the way to the 423.6 fib, as you can see, to the pip. So this is something that can happen, but specifically most of all on lower time frames, sometimes even on medium time frames occasionally. And that happens when you have, you know, a reversal often, or the start of a new trend can sometimes be very impulsive, or even in the middle of the trend, by the way. At the end of the trend, roughly speaking, you will not see such an extension. That's just a rule of thumb. All right, so you can see price hitting target. There's a little bit of a consolidation there, also at the minus, a little bit, no more at the minus 61. And more or less almost one straight move up to the main and last target. Pretty impressive run under your last week, Friday. All right, so these are, I think, for the moment, the key things to keep in mind as part one. Let's see. I'm just checking if there are other questions. Is there any questions at this moment? Sometimes, indeed, fib levels can have the reverse effect. If it was support in the past, it can become resistance in the future, indeed. That's possible. And you'll see that many of these Fibonacci levels have been past support or resistance levels, and they can become future levels as well. They're quite often used. One thing I should add is that the Fibonacci retracement level is not the only fib tool that is part of your options. You have, if you go to insert Fibonacci, you have time zones, fan, arcs, and expansion. I don't use any of them, but you, of course, can definitely try them out and see if there's something for you. You have expansion, which means that you start with 1 point, you keep clicking, you keep holding, just like with the retracement. Let go when you find the spot, and then you drag the third spot to the retracement level. So you have a swing, start and end, and then you have the retracement spot. And then these are the expansion targets. But the thing is that I have, with the retracement tool, I already have the targets there. The target tool is as an extra, an addition to the retracement tool, if you don't have targets on your retracement tool. The cool thing about having minus levels on the retracement tool is you have targets and retracement levels all in one tool. Plus, I have the max correction level if price goes against my analysis. So I have like 3 things on just one tool, which is very efficient in my view, rather than using 2 tools in 2 different occasions. So I don't therefore use this extension tool. You also have time zones like this. It's a bit difficult to see, but they are, let me make that, this is yellow. It's probably very difficult to see for you. 1 second. All right, let's make them violet. So you can see, you take a swing again, based on swings, start and end. And based on that initial swing and the time it took between the start and the end point, this is set as a 1 period from here to here, from here to here. And you can see that the same kind of interval is used as a fib sequence levels. So you get 2, 3, 5, 8. So that gives bigger and bigger spaces. And you can see that goes into the future. It becomes bigger and bigger as we go into the future based on those Fibonacci sequence levels. So this is, let's see, 17 candles is period 1. Period 2 is the same, is 17. Period 3 is 17. But then period 5 is 34 because it increases by a factor of 2 in this case, using that Fibonacci sequence level. So 1, 2, 3, 5, 8 is the sequence level. 17 candles is the length of that first zone. So 17 candles remains the zone that is used for all of the future Fib time intervals. If we make that smaller, let's say we make it 5 candles, then you can see next one is 5, 5, and then it becomes 10, then 15, then another 25 candles. That 5 candles is the basic unit. And based on that, it's multiplied by 2, 3, 5, 8, 13 by the sequence levels, basically. But I don't use that. Personally, I don't use that. It can be handy. I do use time patterns in general, but that's a different topic. Not this one. This is a fan. And you can use, again, the swing. Like, let's use this swing again. So this is the angle of the trend line, quite steep in this case. Here it's a little bit shallower. All right, so that's, I think this was a fan indeed. And then we have arc. Now, arc, all of these I personally don't use, but I think the fan is quite interesting. But let's see what this is. Arc, I've not even sure, to be honest. Expansion is what we discussed. Seems like we need probably a little bit more. 1 second. I don't see any arc. I think it's supposed to give a circle, but I don't see that. Maybe, as I said, I don't use this myself. I think the fans can have some value, but I just draw trend lines rather than use Fibonacci for that. So that is the Fibonacci tools, all the family of tools that you have available in your MT4. And yeah, I think they're really, really useful, specifically the Fibonacci retracement tool, that is, of course, the main tool that I use. And they really help your trading with finding entries, retracement spots, bounce spots, targets, correction, max correction levels. The pro is that those are the pros. The con or disadvantage is the fact that you'll have to find the swing yourself. It's not automated. You'll have to get experience with that. Take it slow and steady. Learn case by case. Learn from experience. Try to maybe look at our chart so that you can see what are the best fibs in which cases. And yeah, look at the part 2, I guess, where that will help you, of course, as well. Part 3 coming up, I think, if I remember correctly, 1 week from now, we'll have part 2. All right, but take a look at the FXDD schedule for more info, or here in Crowdcast. I can quickly look myself. Yes, Sunday, February 3rd, indeed, part 2. All right. I think from a beginner point of view, though, I think we've covered everything as far as I can see. If anything is something you want to add, if you're looking at the YouTube channel, just feel free to write a comment down below, and we'll try to add it in the next webinars. But ultimately, these are the basics from the tool. I see one more question. Okay, great. So that's about it, folks. Wish you all great trading. Happy to be here with you, and looking forward to part 2. We're going to dive into some more advanced materials, and see you all soon. Cheers.